Hey, JB here from Squirrel. Welcome to another one of our short videos on something interesting and exciting. Today I thought we'd talk about the OCR. Obviously very topical. The Reserve Bank this morning reduced the rate from 2.25% to 2%. There'll be a lot of you out there that are excited about the prospect of lower mortgage rates. If you're a saver, maybe not so excited. I guess what I want to talk to today was why I don't think you're really going to see these rate reductions pass through. And I guess that's quite important. So the first graph I'm going to point to you to is wholesale interest rates, and that's referred to as swaps. And what you can sort of see there is that wholesale interest rates have dropped by roughly 1/3% or 35 basis points in the last couple of months. At the same time, credit default spreads, that's basically how much of a risk premium investors need to buy investment quality debt, has been dropping. In other words, you can borrow with a lower risk premium. What that means is that internationally money is very cheap at the moment, and it's been getting cheaper. So in a normal course of events, that would mean lower borrowing rates for consumers. But things have changed a bit. And I guess they've changed a bit in a couple of contexts. The first context is that the Reserve Bank's put in some pretty strict loan-to-value criteria to try and slow down the housing market. And so from a bank perspective, it's moved from a growth focus, let's shovel as much debt out there as we possibly can, and to one that's very much now constrained. And with very limited growth. So the banks aren't looking to chase growth and fund growth anymore. They're very much looking to maximise the profitability of the existing business that they have. So there's not going to be so much price competition in the mortgage market anyway. So although their wholesale funding costs are coming down, the other side of that is that the New Zealand banks actually have to fund the bulk of their deposit funds locally from New Zealand investors and savers. And that's where you see a slightly different story. So if we look at online call accounts, which the high interest savings accounts, you can see the interest rates are actually very, very low. But what you can see is in the last couple of months, they've actually only dropped by less than 0.1%, which is far less than wholesale interest rates have been dropping. In other words, banks are actually having to pay more for retail deposits than they did 2 or 3 months ago. Equally, the same's true of term deposits. So this is just looking at the 90-day term deposit. And what you can sort of see there is over the last couple of months, although wholesale interest rates have been dropping, there's been no change at all in terms of term deposit rates. Again, banks are having to comparatively pay more for local deposits. And so what happens is we're going to get an OCR decrease that's coming through in the wholesale interest rates, but it's not changing how much banks actually have to pay for their domestic funding. And the implications of that are that I don't think you're going to see a significant shift in terms of mortgage interest rates. You'll probably likely see some level of competition drive some headline rates below 4%. Because the banks will be, I guess keen to have something with a 3 in front of it, but I wouldn't expect to sort of see rates move significantly below where we're negotiating them at the moment, which is sort of around that 4 to 4.1%. As I said, you might get some rates around 3.9, 3.95, maybe with a 1-year special or some sort of 2-year special. But there's now a lot less price competition between the banks and the mortgage market. And the reality is that domestic funding rates aren't dropping. So they're less inclined to want to compete too aggressively in the space. So that's enough for me on this topic. Join us again for the next one. Cheers.